Two people start the same job on the same day, same salary, same ambitions, same slightly uncomfortable office chair. One opens a Roth IRA, the other maxes out their 401k. They both invest in the same index fund for 30 years. They both retire at 65 with roughly the same account balance on paper. One of them has significantly more money to actually spend. The difference has nothing to do with the stock market, nothing to do with timing or luck or picking the right companies. It comes down to a single word that sounds boring until you do the math, and then it sounds like the most important word in your financial life. That word is taxes. Let's establish something uncomfortable right away. Most people don't choose between a Roth IRA and a 401k. They default. Their employer hands them a form during onboarding. They check a box, and they never revisit it. The decision that could determine whether they retire comfortably or retire stressed gets approximately as much thought as choosing a sandwich at lunch. And the financial industry doesn't exactly rush to fix this, because confusion, passivity, and inertia are all very profitable for someone, just usually not for you. So here's what actually matters, explained without the jargon, without the false certainty, and without pretending this is simpler than it isn't. Start with the 401k, because that's where most people begin. A 401k is an employer-sponsored retirement plan. Your company sets it up, you opt in. Every paycheck, a portion of your salary gets diverted before taxes into an investment account. That pre-tax part is important. If you earn $5,000 a month and contribute $500 to your 401k, you only get taxed on $4,500. The government essentially lets you skip the tax line today. Your money goes in, hits the market, and compounds for decades. The IRS watches patiently. It doesn't touch you. It waits. Then you retire. You start withdrawing. And every dollar you pull out gets taxed as ordinary income. The IRS has been very patient. Now it's done waiting. You pay taxes in retirement on every withdrawal at whatever the rates happen to be then. That's the deal. Defer now, pay later. The Roth IRA works in reverse. You open one yourself. It doesn't come through your employer. You contribute money you've already paid income tax on, after-tax dollars. There's no immediate benefit, no tax break today. You fund it and it feels honestly a little thankless at first, but then the money grows for years, for decades, and when you eventually withdraw it in retirement, the contributions, the gains, all of it, you pay zero in taxes, not reduced, not deferred, zero. The government already got its cut when you earned the money. Now it has no claim on what it became. Same destination, two completely different toll booths, and the size of those tolls depends on something neither account can tell you: what tax rates will look like in the future, and what income bracket you'll be sitting in when you finally start pulling money out. Here's where the comfortable simplicity breaks down. Personal finance content loves to declare a winner. Roth IRA, usually. Tax-free growth sounds incredible, and it is. So the Roth gets pushed as the obvious move, the smart move, the move that savvy people make. What that framing quietly ignores is the central variable: your tax rate now versus your tax rate later. If you're early in your career, earning $50,000 a year in the 22% bracket, the Roth is likely the right call. You pay taxes on your contributions at today's relatively low rate, let everything grow untouched for 30 years, and withdraw it all tax-free in retirement. You locked in a low tax rate when you had one. But if you're in your peak earning years, a doctor, an attorney, a senior executive making $350,000 annually, you're looking at a marginal rate of 37%. Paying taxes now on Roth contributions at 37% is expensive. If you expect to draw significantly less in retirement, contributing to a traditional 401k and deferring those taxes until you're in a lower bracket might actually net you more money after taxes over a lifetime. The math isn't complicated, but it requires honesty about where you are and where you're going, and most people haven't done it. Now here's why 2026 specifically changes the conversation. The Tax Cuts and Jobs Act of 2017 was a sweeping reduction in federal income tax rates. It wasn't permanent. It was always scheduled to expire, and that expiration date was the end of 2025, which means that right now in 2026, those cuts have either lapsed or are in active political negotiation. Without a legislative extension, rates revert to pre-2017 levels. The 22% bracket edges up to 25%. The 24% bracket climbs to 28%. Middle-income earners who felt comfortable with their tax burden could find themselves paying meaningfully more, and that shifts the calculus. In an environment of rising tax rates, the Roth becomes more attractive for a simple reason. You'd rather pay taxes today at a known rate than gamble on what those rates look like in 2045. The Roth is, among other things, a hedge against future tax increases. It trades certainty today for certainty tomorrow. Given the current trajectory of U.S. federal debt, which is not trending in a direction that suggests lower future taxes, that hedge is starting to look less like paranoia and more like prudence. There are two other factors that don't get enough attention. First, the employer match. If your company offers a 401k match, say dollar for dollar up to 4% of your salary, that is free money, guaranteed, immediate. A 100% return before the market does a single thing. No Roth IRA, no matter how beautifully it compounds, can replicate that, which is why the near universal correct first move is this. Contribute to your 401k at least enough to capture the full employer match, whatever that requires. Leave nothing on the table. Then make decisions about where additional savings should go. Skipping the match to fund a Roth instead is one of the most expensive mistakes people make while feeling responsible about their finances. Second, contribution limits and eligibility. In 2026, the 401k contribution limit sits at $23,500. The Roth IRA caps at $7,000 and disappears entirely if your income exceeds roughly $161,000 as a single filer, or around $236,000 for married couples filing jointly. If you're a high earner, the Roth IRA may not even be an option at full contribution. There are workarounds, the backdoor Roth conversion being the most well-known, but they come with their own complexity and tax considerations. Then there's the question of what happens when you're old and you don't actually need to spend the money. Traditional 401ks carry required minimum distributions, RMDs. Starting at age 73, the IRS forces you to begin withdrawing money from your account, whether you want to or not, because it has been waiting to tax that money, and it is done being patient. If you've saved aggressively and your account has grown substantially, those mandatory withdrawals can push you into a higher tax bracket in retirement than you anticipated. Roth IRAs have no required minimum distributions during your lifetime. You can leave it untouched. You can let it compound for another decade past 73. You can pass it to your heirs who inherit it with favorable tax treatment. The Roth, in this respect, is quieter, more patient, less demanding. For people thinking about legacy and estate planning, that distinction alone often tips the scales. So what's the actual answer? The honest answer is that the question is slightly wrong. It's not really Roth IRA versus 401k. It's how do you deploy both accounts strategically across your working life to minimize lifetime tax exposure. The framework most financial planners use looks something like this. Contribute to your 401k up to the employer match. Always? Then fund a Roth IRA if you're eligible. Then, if you have more to save, go back and contribute further to the 401k. In lower income years, career transitions, early career, sabbaticals, consider Roth conversions, moving money from traditional accounts into Roth accounts and paying tax now at temporarily reduced rates. Build flexibility. Diversify your tax exposure across account types the way you diversify across asset classes. The people who retire well don't just save money. They engineer when and how they'll be taxed on it. But here's the thing that stays with you after you've understood all the mechanics. The entire framework, both accounts, every strategy, all of it, rests on the assumption that you can predict your future tax environment with enough accuracy to optimize for it today. And the one thing that 30 years of economic history suggests most clearly is that the rules will change, rates will shift, legislation will rewrite the terms. What's optimal in 2026 might look naive by 2040. In the end, Roth IRA versus 401k isn't really about which account is better. It's about one decision. Do you want to pay taxes now or later? Because over 30 years, that choice can mean keeping tens of thousands of dollars or handing it back to the IRS. Same salary, same investments, same market. But one smarter tax decision can change everything. And sometimes, wealth isn't built by earning more. It's built by knowing the rules before everyone else.